We're not sure if you realize this, but according to a survey conducted by Nationwide, 92% of Americans couldn't identify the key factors involved in maximizing their Social Security benefit, even though 53% claimed that they knew exactly what to do to get the most income. And according to recent statistics, the difference between your number one best strategy and your second best strategy may mean the difference in tens of thousands, if not hundreds of thousands of income over the course of your retirement. But in this short 15-minute presentation, we're going to highlight three key areas that will help you ensure that you get the most from your Social Security benefit. So we're going to talk about basic strategies to help increase your initial benefit. We're going to talk a little bit about how you minimize taxes on Social Security. And then we're going to talk about some tips on how you integrate Social Security with everything else you're doing to relieve some of the pressure on your other investments. And once you learn how to use these strategies in your own financial plan, you'll be able to ensure that you get the maximum benefit based on your specific financial situation. Now, we're not going to be able to cover every guideline and strategy because this presentation is only going to be about 15 minutes. But make sure that you stick around to the end because we're going to show you how you can get some additional resources, including a really well-known book about Social Security and how you can run your own personalized Social Security report at no cost. And this will actually do a lot of the computational analysis for you to help prevent you from making an irreversible mistake that could cost you thousands of dollars. My name is Sam McElroy, and this is Tad Cook. And we've been providing training to individuals and advisors for over 10 years on a variety of topics, everything from estate planning, Social Security planning, retirement income distribution. And we hold certifications in Social Security planning from the National Social Security Association. Now, you, like us, probably don't spend morning, noon, and night thinking about Social Security, and neither did we. But our level of expertise rose out of necessity. You know, we're a Chicago-based firm that personally serves over 500 families, and most of our clients are retired or getting ready to retire. And just like you, they had questions pertaining to Social Security. So now we can use all that we've learned over the years to help you make the most out of your Social Security benefits through our public education series. You know, in some instances, you may have over 500 different ways that you could literally utilize your Social Security benefits. But right now, we're just going to walk you through three main areas of how you can maximize your Social Security. So Tad's going to walk you through some of the foundational concepts that you're going to need to know in terms of how Social Security works.
And let's start with knowing a little bit about the rules and starting with how are Social Security benefits actually figured. Most people are not aware of this, but they are actually based on your highest 35 years of earnings. It doesn't matter what order those years are in. They are just looking at your entire work record and taking your highest 35 years of earnings. That little balloon down on the bottom right-hand side of the slide shows that the maximum in 2020 that Social Security taxes is up to $137,700 worth of income. After that, Social Security no longer taxes income above that threshold. They take those top 35 years of earnings from your work record and add them all together. That's your 35 years of taxable earnings, again, your highest 35 years. And then they divide that figure by 420 months. They use 420 months because that's exactly how many months there are in 35 years. They then take that figure and multiply the first $885 by 90%. This is what the Social Security Administration calls a bend point. It's B-E-N-D. So the first bend point is $797. Then they're going to take from that 9831 figure anything over 885 but less than 5336, and they're going to multiply that by 32%. It's bend point number 2. And then number 3 is anything over 5336 is multiplied by 15%. You then add together the three bend point figures, and that's your monthly benefit up for retirement age. As we say at the bottom of the slide, we are not making this up. We also want to assure you, though, that you do not have to do this calculation yourself. Social Security will do it for you, and they do an excellent job, as long as your work record is accurate. Now let's go on to this next slide, and let's look at what the actual monthly benefits look like. And let's start in the middle of this slide. The full retirement age for anyone that is retiring this year is age 66. At that age, you're going to get 100% of your benefit. The average benefit today is $1,368 per month, and the maximum benefit at full retirement age is $2,895. Notice in the second column where it says percentage of full benefit that if you start taking your benefit earlier, it's going to be a reduction from your 100% benefit. Also, if you wait beyond age 66, it is going to increase by 8% per year. And so if you wait until age 70 to start taking benefits, you'll actually get 132% of what your full retirement age benefit would have been. But you want to look at a break-even analysis. What is that? Well, let's say that you're saying, I could wait till age 70, but if I can start taking benefits at age 66, if I wait till age 70, I will have missed the first 4 years of benefits. How long at my higher age 70 monthly benefit will it take until I have as much money as I would have had if I started at age 66? The things that come into determining a break-even analysis are things such as longevity. And again, it's a guess for any of us, but looking at family history, you're in great shape at age 65 or 66, and you say, I'm going to continue working. Maybe I will wait a little bit longer. But doing a break-even analysis is an excellent way to start to formulate your best strategy. Let's also talk for a moment about spousal benefits. Many people are not aware that these exist. Your spouse, if you have been married for at least 1 year, or if you were previously married and are not currently married, but were married to someone for 10 years or more, you're entitled to a spousal benefit, which is half of the primary worker's full retirement age benefit if they're starting at their full retirement age. So let's look at this case example where Jane and John, a married couple, Jane's insurance amount is $2,000 per month, and John's is $800. If he called Social Security would say, well, John, if Jane is taking her monthly benefits, you're actually entitled to half of her monthly benefit as a spousal benefit. That $1,000 spousal benefit is more than your $800 from your own work record. We would recommend that you take the spousal benefit. And in fact, Jane could take $2,000 per month and John could take $1,000 per month for as long as they live. Let's look at a quick case study here. And we have a female, age 63, planning to retire within the next 2 to 5 years. Her primary insurance amount is $2,350. Her cost of living adjustment, we're assuming, is 2% per year, and the discount rate 2% as well. We're assuming that she's going to live to age 85, and her initial plan was to wait until age 70 to start benefits. Now, if we look here with the Social Security maximization report that we run for our clients, you can see that that star is indicating that actually to maximize her benefits, she would be best starting at age 68. And she would get an additional $19,981 by taking her full retirement age benefits at 68. Actually, it's a little bit beyond full retirement age. And the alternative age of 65, she would be increasing that by nearly $20,000. So this is the type of analysis that you want to do with your Social Security benefits to determine what's best for your individual situation.
Yeah, most people don't realize this, but if you actually look at the manual for Social Security, there's over 3,000 different rules and guidelines. And obviously we can't touch on all of them here, but this is an example that Tad just went over of someone who actually may have been better off taking their benefit a little bit earlier, even though she didn't know that. Similarly, another key area to look at in terms of maximizing your Social Security has a little bit to do with taxes. At the end of the day, if you think about your overall goal in retirement, assuming that it's related to Social Security and retirement income, is that what you really care about is the net usable amount. So to the degree that you can minimize or mitigate taxes, you can often get more usable income from the income source. Now, Social Security for some people may be tax-free, and for others, some portion of it may be taxable. And here's a quick way to kind of think about it. So if you're filing an individual return and your combined income, which is a specific Social Security term in which they're looking at your adjusted gross income, plus any non-taxable interest income, plus half your Social Security. But if that's under $25,000 or whatever the threshold is in the given year, then your Social Security benefits will not be subject to income tax. And similarly, if you file a joint return, then if that's under $32,000, again, your Social Security benefits will be income tax free. But if you're between 25 and 34, or between 32 and 44,000, then up to half of your Social Security benefit may be subject to taxes. And if you're over that, then up to 85% of your benefits may be subject to taxes. But no matter how you look at it, we always consider Social Security income to be what we call a tax-advantaged income source. Because no matter what, at least 15% of your Social Security will be income tax-free. And in many instances, there's things that you can do to even reduce that further. Now, we're a Chicago-based financial firm. And so here in the state of Illinois, one of the key distinctions is that Social Security benefits are not subject to taxes at all, even though many of the surrounding states around us actually do tax Social Security and other retirement income. Now, a lot of times when people see those numbers, they automatically think that no matter what they do, they're going to be in that upper bracket, and they should just expect that 85% of their Social Security is going to be subject to income taxes. But we found over the years that almost everybody has something they can do to either reduce their adjusted gross income or do something to reduce how much of their Social Security may be subject to taxes. And it could be anything in terms of coupling it with rental income, where you can use depreciation and expenses to offset the cash flow, dynamic withdrawal rates, where you're utilizing distributions from cash value life insurance, paying attention to the type of interest income you're earning in taxable accounts, looking for qualified dividend income, Roth conversion strategies, certain trust structures, and it goes on and on and on. One of the reasons we always stress having a personalized Social Security report done, though, is again, it will do a lot of the computations, and it can really help identify what strategies you may be able to utilize to make sure that the lowest amount of your Social Security is subject to taxation.
So let's look at coordinating benefits here and strategic coordination. And we want to introduce the idea that most of you know that Social Security is not going to be enough to live off of, and that you are going to need income from other sources. But most of us have gone through life trying to accumulate money in a growth strategy. In other words, trying to get as much growth return to build our retirement portfolio while we're working. But we want to introduce the idea to you that the total return you're receiving on your investments is actually made up of two components: income plus growth. And in retirement, it's income that you're interested in obtaining from your portfolio, not as much growth. So let's show you 3 examples here and explain how this works. If you go to a bank and you were able to get a CD with a 10% fixed interest rate, we know that's not realistic in today's environment, but for the sake of illustrating this, it's easier to use. So let's just say you take $100,000 and go to a bank and buy a 10% fixed CD. You know you're going to get $10,000 worth of interest. That's paid to you in cash. So it's very easy for you to spend that money as income because they're paying it to you that way. On the other hand, if you still had money invested in a growth stock in the stock market, and that stock were to go up 10% in value from one year to the next, you wouldn't be able to use that money. It's not coming to you in income, it's coming to you in growth. To be able to use that 10%, you would have to sell the security that had that increase in value. So that's not as useful to you during retirement. If you have a mutual fund or an exchange traded fund, same way. Some of that return you get might come in income that you could use for retirement income, but some of it may also come from growth. So the whole idea here is you really want to take a retirement portfolio and reorient it so that you now have as much income as you can get from your portfolio, because growth is no longer what's as important to you. This is now turning a growth portfolio into an income portfolio.
Yeah, and to dovetail off of that, if you're not earning enough of your return from the I and you're too heavy on the G, it may actually prevent you from using certain helpful Social Security strategies because it creates certain retirement and investment risks that aren't normally present. So as we mentioned before, in some cases, there may be literally hundreds of potential Social Security strategies that you could utilize to try to maximize your benefits. And again, the difference between what's your number one best strategy and your second best strategy may mean the difference in tens of thousands, if not hundreds of thousands of dollars in income over the course of your retirement. Now, the way that you can make sure that you don't miss out on potential income is to understand all of your options so that you can compare them. And typically you do that by running a personalized Social Security report based off of your primary insurance amount. But because we feel like this is more important now than ever, given the state of the economic environment, we're making a limited time offer where you're not just going to get the personalized Social Security report, but you're also going to get a white paper on Social Security talking about some common strategies. You're going to get a book, a really well-known book around Social Security planning called Getting What's Yours. And you're also going to get a 15-minute consultation with a certified national Social Security advisor. And that's basically to help answer any questions you have, but also to make sure that that you understand how to read the Social Security report once you actually run it. And all of this is complimentary as part of you watching this brief presentation. In fact, Eric from our office, who runs the public education series, is going to connect with each of you to be able to help make sure that you get all the things that we discussed. And remember, even an extra $500 a month in Social Security income may reduce the cash flow pressure on 100,000 to 200,000 plus of your portfolio. So it's important to be absolutely sure that you get it right. So thanks again for watching the presentation, and we look forward to talking to you soon.
Thanks, everyone. Take care.